Hello, children. Today we are going to solve the second problem on incidence of tax. See, this problem is appeared in the year November 2011, 2016 in section C, which carries 12 marks. Okay. First, I'll read the problem. Later on, we'll do the solution. Okay. From the following particulars of Mr. Tushar, compute his gross total income for the assessment year 2024-25. First one I'll read. Income from business in Hubli rupees 1 lakh. So here we need to understand the income is generated in India. Why in India? Because Hubli is resided in India. Hubli is in India. That is in Karnataka. Okay. So Karnataka is in India. So I do treat this as an Indian income. In the first place, I say this is an Indian income. Okay. Indian income. As I told, how do we define Indian income? Four things should happen in India, that is earned in India, raised in India, received in India, then accrued in India. If any one of this falls in India, that we treat as an Indian income. So we go to the second one. Profit from a business in UK, controlled from India, rupees 60,000. See here, profit from a business in UK, controlled in India. Profit is earned where? In United Kingdom, UK. But it's controlled in India. That means the head office may be in India. From head office, the instruction is given. The business is running in UK. So there the profit is generated. That is basically this type of an transaction. We call it as a controlled income. Controlled income. Controlled income. See, if it is a controlled income, it is taxable in two cases. That is resident and ordinarily resident. Resident but not ordinarily resident. Whereas in the first case, income from a business in Hubli, Indian income is taxable in all the three cases. ROR, that means resident and ordinarily resident. RNOR, resident but not ordinarily resident. NR, that is non-resident. Okay. We go to the next one. Coming to the third point, what it says income from house property in Japan, not received in India, rupees 50,000. So we say the income from house property, the house is in Japan, the income is generated in Japan, but none of the amount is received in India. India has received no amount. The revenue is generated in Japan, earned in Japan. India has nothing to do. So this transaction, we call it as a foreign income. Why? Because everything is generated in India. Money, nothing we have not received in India. So everything is generated in Japan. Nothing is received in India. So those type of an account, we call this as a foreign income. That means any income received in foreign, we call that as a foreign income. We go to the fourth point. Income from a business in India, but received in Pakistan. See, earned in India. The business is in India, earned in India, but the amount was received in Pakistan. So this we treat as an Indian income. Why Indian income, children? Even though the amount is received in Pakistan, where is the business setup? It is in India. So as I told, the definition itself, it defines as any income earned in India, any income raised in India, any income received in India, any income accrued in India, any one, if this thing is satisfied, so we treat that as an Indian income. Here, the business is in India, so we call that as an Indian income. Salary computed, received in India for service rendered in USA. See, salary received in India, but the service which is he was working in USA. Rupees 70,000. See, here it is satisfying. We call this as an Indian income. Why Indian income? Because the salary is computed. India, the received transactions happened in India. So we call it as an Indian income. Interest on deposit with State Bank of India in Bengaluru. See, the transaction deposit, it happened in Bengaluru. That means Bengaluru is in India. So we treat that as an Indian income. Now, profit from a business in Sri Lanka, controlled from India. See, profit from a business, the profit is earned in Singapore, but controlled in India. See here, two things we have. One is a controlled income. Why? Because India has an head office, but the business is running in Singapore. Profit earned is in Singapore. So controlled in India. So we call that as a control income. But in apart from that, they have mentioned one-third profit received in India. That means out of 30,000, 10,000 is received in India. So again, we have here an Indian income. Two things we have here. One is a controlled income, the other is an Indian income. So two things are there. So 10,000 is taxable in all the three cases. Controlled income in the under ROR, RNOR, we have to mention 20,000, 20,000. So amount will be splitted here. Okay. That later on we see when we are doing the computation of total income. We'll understood, children. We'll go to the next one. Past untaxed foreign income brought to India. See, any untaxed income which is brought to India, that is exempted. Exempted income. We treat that as an exempted income and it's not taxable in any of the three cases. Dividend received from domestic company rupees 5,000. Any dividend which is received in India, that will be treated as an Indian income. Indian income. Why? Because the domestic means India. Dividend has happened, earned, received everything in India. So we treat that as an Indian income. Interest on post office saving bank rupees 8,500. See here, there is one twist where post office saving bank account, we treated that as an Indian income, of course, but there is an exemption of 3,500 interest, whatever we earn from the post office. So we have to deduct 8,500 minus 3,500. The balance 5,000 will be taxable in all the three cases. Okay. Agriculture income earned in Nepal, 25,000. This we directly treat as a foreign income. Foreign income. Why? Because see here, agricultural income which is earned in Nepal. Nepal is not in India. So if it is in India, it would have been an exempted income. But Nepal is not in India. Where in Nepal, the agricultural income, they were plowing something and earned the income related with the agricultural 25,000. So we treat that as a foreign income. Commission received in India for the service given in Nepal. See, anything we receive in India that we treat as an Indian income and it is taxable in all the three cases. Now we go, children, now we go with the computation of income. Okay. So as I told the format, computation of income, and here we are going to write the name of an assessee. Here the assessee, we call him as a Mr. Tushar. Mr. Tushar. 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 Okay. He is an assessee. Again, on the right-hand side, we are going to mention the previous year 23-24, assessment year 24-25. So I'll read the problem one by one transaction I'll read. Before that, the format you need to see. For the first column is serial number. The second is types of India. Third, we have a nature of income. Then ROR, RNOR, NR. Okay. So first, I will read income from a business in Hubli. Again, children, how do we treat it? We treat this as an Indian income. So I hope so you have understood. Hubli, why? Because Hubli is in India. It is in Karnataka. So if it is in Karnataka, any income received in India that we treat as a an Indian income. So it is taxable in all the three cases. So I'll mention 1 lakh, 1 lakh. Okay. So first I'll just put it as a comma so that it will be more clear. I'll just go here, comma, and I'll reduce it. So we have 1 lakh. Okay. Now fine, 1 lakh. So I'll copy it down. So all the column I'm going to show it 1 lakh, 1 lakh, 1 lakh. Okay. So this we have. Next, profit from a business in UK controlled from India, rupees 60,000. See, how do we treat this one? This is, we call it as a controlled income. Why controlled income, children? Controlled income. Why it is a controlled income? Because, see, the profit is earned in UK, United Kingdom. Business also is there in UK. From the business, we have earned profit, but the head office, the instruction is from India. So it is taxable in two cases that we call it as a controlled income, taxable in two cases. That is, we have a resident and ordinary resident, and resident but not ordinary resident. And in non-resident, it is not taxable. So I'll mention it as 0. Okay, next. Income from house property in Japan, not received in India. So Japan is a foreign country. The there was a house property and some revenue has been generated from the house property which is situated in Japan. Nothing is received in India. Amount has not come to India. So what do I treat? I treat that as a foreign income. Foreign income. So it is taxable in only in case of if he is the individual is a resident and ordinary resident, it is taxable only in that case. So I'll mention as 50,000 and rest both the column I do mention as a 0, 0. Now coming to the next one, income from a business in India received in Pakistan, rupees 30,000. See, any income which is received in India, either it is income received, earned, raised, accrued, whatever may be, we treat that as an Indian income. So, Indian income directly, I'm going to write and mention it as a 30,000, which is taxable in all the three cases. Okay, children, understood? Next, salary computed received in India for service rendered in USA, rupees 70,000. See, what did I say? Again, I do treat this as an Indian income. Why Indian income? Even though he has worked in USA, but salary where is he received? In India. That means it has satisfied the Indian income definition. So we call it as an Indian income. So 70,000 is taxable in all the three cases. Hope so understood, children. What do you mean by Indian income? Okay. Next, interest on deposit with SBI of India in Bangalore. See, Bangalore, obviously, what we do, we call it as an Indian income and it will be taxable in all the three cases, 20,000. Interest is received from SBI. The bank is situated where? In Bangalore. Bangalore is in Karnataka. Karnataka is in India. So, income is generated here itself. So, it is taxable in all the three cases. Profit from a business in Singapore, controlled from India, one-third profit received in India, rupees 30,000. See here, the business where the business is, it is in Singapore. Singapore is a foreign country, so the profit earned there, but controlled where? From India. That office in India. Therefore, they were following the instruction from India. Based on the instruction, the profit was earned in Singapore. So I treat that as a controlled income. When I say controlled income, it is taxable in two cases. One is ROR, the second is RNOR. Okay, so how much they say? One third, one third. Okay, if it and again one third in the sense that is received. Okay, 30,000. Again, we have an Indian income. What is that Indian income? See, one third profit received in India, rupees 30,000. Out of that 30,000, one third is received in India. Whatever received in India, we call it as a treated as an Indian income. So two things are there. One is a controlled income. The second is Indian income. Now, Indian income first I will write one third of 30,000 that comes to 10,000. Okay, 10,000 is taxable in all the three cases. And controlled income, I say balance. 10,000 minus 30,000 will be 20,000. So 20,000 is taxable in only two cases, controlled income. Here I'll mention it as 0. Understood, children? There is a split of, in the one transaction itself, we say that is a controlled income as well as Indian income. Next, past untaxed foreign income brought to India. Any untaxed foreign income which is brought to India during the previous year, it is exempted. Exempted income. So what do I do? That is a tax free. So I cannot mention here tax free because it will have a problem while totaling. So what do? I put it as 0, 0, 0. Okay. Next. Dividend received from a domestic company, rupees 5,000. See, any dividend received in India that is taxable in all the three cases, we treat that as an Indian income, and 5,000 rupees, 5,000 is taxable in all the three cases. 5,000 taxable in all the three cases. So I do mention, okay, I'll copy it. Okay. So domestic company, domestic means in India, dividend. I know, I hope so, children, you understand what is the meaning of a dividend. Okay. From the share, we get a dividend either on quarterly or off yearly or yearly. So that dividend, it is if we treat that as a received in India, we treat that as an Indian income and it is taxable in all the three cases. Interest on post office saving bank account 8,500. See here there is an exemption of 3,500. Any interest received from the post office, there is an exemption that I am going to mention here. See, according to the IT Act, it says 8,500 minus 8,500. I'll mention here 8,500 minus 3,500. 3,500 is an exemption amount. Okay. According to the Act, it's an exemption amount. 500 is an exemption amount. So 8,500 minus 3,500, it comes to around 5,000. So taxable is 5,000. Taxable 5,000 in all the three cases. Interest from, again, I'll say, any interest received from the post office saving bank account, we treat that as an Indian income. In India, if we receive, so there is an exemption of 3,500. So total interest, how much they have received? 8,500. 8,500 minus 3,500, the balance 5,000 is taxable in all three cases. Next, we have agricultural income earned in Nepal. So Nepal, where is it? Does not relate to Indian income. So it is a foreign income. So what do I mention as a foreign income? So if it is a foreign income, taxable in only one case. Okay. Only one case. Rest all I'll mention it as 0, 0. Now coming to the last one, commission received in India from a service given in Nepal, rupees 10,000. Wherever the service is given, we don't mind, but commission received in India. So India is accepting the money, where India is receiving the money. So we treat that as an Indian income, and it is taxable in all the three cases. That means the rupees 10,000 is taxable in all the three cases. So I'll mention it as 10,000 copied here. So, okay, children, we got the amount. I'll just put it down as a comma. So I'll reduce it here. So, okay, children, this is somewhat the total we got for in case of resident and ordinary resident, 4,05,000. In case of RNOR, that is resident but not ordinary resident, we have 3,30,000. And in case of a non-resident, we have 2,50,000. So this is something related to the second problem. This is a very important problem related to the examination of BCom. And children, if there is any doubt, just get back to me in the comment section, okay? So thanks a lot, children, for watching this video. Thank you.